Every 4 years, markets hear a story. The World Cup lifts sportswear giants, fills hotels, and moves stocks. Sometimes prices twitch with narratives. Sometimes the tournament is already priced in. This episode separates the World Cup effect as marketing myth from the World Cup effect as measurable sector stress. Sportswear, tourism, hospitality, media, and betting adjacent names, without turning the show into stock tips. Quick note, this is education, not investment advice. Full disclaimer in the description. First principle, a global audience is not the same as an earnings surprise. Nike, Adidas, and peers run World Cup cycles through sponsorships, team kits, and retail drops. A famous kit can spike sellouts and still be a rounding error inside a multinational's annual revenue. Look for revenue shares in the filings when you can. Refuse vibes. Put a number on that attention. FIFA has claimed a cumulative global audience climbing from roughly 3 billion in 2010 to around 5 billion by Qatar 2022. A marketing number, not a stock number. Billions of eyeballs do not automatically become billions in ad revenue. They become inventory that still has to be sold at a price advertisers accept. Hospitality and travel names face a sharper local pulse. Host city hotels, airlines with routes into hubs, and short-term rental platforms see demand concentrates into match weeks. Displacement matters. World Cup visitors can crowd out other tourists rather than stack on top of them. Gross booking headlines can overstate net new activity. Media rights holders monetize attention. Broadcasters and streamers sell ads against peak audiences. Ad markets also depend on the macro. If brands cut spend, a big event helps less than the pitch deck promised. Equity markets are expectation machines. If investors already assumed a strong cycle, good tournament news may not lift prices. If a brand misses on inventory or China retail while the cup runs, the cup will not save the chart. Attribution is hard. That honesty is the episode's spine. Currency and country risk show up at the edges. Mexico tourism receipts, Canadian services, U.S. city tax takes different scales. A $17 billion U.S. GDP impact claim can be both huge in dollars and small as a percent of U.S. GDP. Here is what this means for your money. Watching markets during the Cup can feel like a sport. Treating that feeling as a trading plan is how attention becomes a fee you pay the market. If you own broad index funds, you already own tiny slices of many Cup beneficiaries and Cup-irrelevant firms. We are not telling you to buy sportswear stocks in June. We are telling you how event narratives enter price. Worked example without advice. List 3 sectors: apparel, hotels, media. For each, name 1 publicly listed firm, 1 Cup-related revenue channel, and 1 non-Cup risk that could dominate the quarter. The exercise trains skepticism. Historical caution. Past Cups produced mixed stock stories. Sponsors win mindshare. Local construction booms sometimes bust after. North America's existing stadium model reduces one classic hangover and keeps retail and hotel dynamics central. Dig 1 layer deeper on apparel. Team kits create scarcity drops. Resale markets form. Counterfeit supply rises. Brand protection costs rise. The consumer sees a jersey. The firm sees a campaign P&L with returns, fraud, and channel conflict. Dig into airlines. Load factors into host cities can rise, while yields rise too. Ancillary fees, bags, seats, behave like junk fee cousins from our other episode. Event travel is a stress test of that fee machine. Municipal bonds and city budgets rarely trend on YouTube, yet security and overtime sit there. FEMA funding and local security spending stories rarely make headlines either. Public cost is part of the market ecosystem, even when it is not a ticker. Betting operators and prediction-adjacent platforms see volume spikes. Their equity stories are regulation stories as much as sports stories. We cover gambling risk literacy in a separate episode. Here, Note only that volume spikes can lift narrative stocks and invite regulatory attention. If you remember one sentence, the World Cup sells certainty of attention and uncertainty of profit attribution. Markets price both. Curiosityverse, money and the systems behind it explained honestly, not investment advice. Event studies in academic finance try to measure abnormal returns around sports outcomes. Results are mixed and often small after costs. Retail traders usually do not beat spreads and emotions on narrative days. Options implied volatility can rise into kickoff, a price of uncertainty, not a free forecast. If you show an option screen, label it educational and refuse contract tips. None of this means volatility around the tournament is meaningless. Implied volatility pricing itself is a real, tradable fact, just not a directional call. A market maker who prices cup month options is not predicting a winner. They are pricing the width of possible outcomes and charging for the uncertainty. That distinction, pricing uncertainty versus predicting an outcome, is the whole difference between a derivatives desk and a fan with a hunch. Earnings season sometimes overlaps the tournament, and analysts on the call often ask a cup question. Listen for how an executive answers it. A precise response, segment revenue, unit growth, geographic mix, signals the number is real inside the business. A vague answer about being excited about the tailwind signals a marketing line built for the call itself, not a disclosed financial fact. Private contractors, security, cleaning, local kit makers are a thick slice of the real cup economy that never trends on finance Twitter. China and other large apparel markets can dominate sportswear earnings even during a North American Cup. Read the geographic segment note. Currency chatter around tourism pulses may be more visible for Mexico or Canada than for the United States simply because of scale, and still get dominated by other macro forces. Retail inventory gluts after a cup can hit the hangover quarter harder than the kickoff quarter. Index investors already hold diversified cup exposure. Trying to overweight a single apparel name for 4 weeks is a concentration bet dressed as fandom. Academic finance has a name for chasing a headline instead of a filing. Event-driven sentiment trading. Volume spikes around a big story without a matching information edge. A trader who buys a sportswear name because highlights are trending is trading a narrative, not a balance sheet. Narrative trades can work by luck. They do not work as a repeatable edge, because the story is public and priced by everyone at once. Curiosity about the cup's economic footprint does not require picking a winner. A diversified travel and leisure or global consumer sector fund captures hotels, airlines, and apparel together, spreading the same exposure across dozens of names instead of concentrating it in one. That is a structural difference from a single stock bet, not a stock tip. Sector funds still carry sector risk, just not company-specific risk. Break the sector map into 5 pieces. Apparel, kit launches, factory orders, full price versus outlet mix. Hotels, adder occupancy, group blocks versus transient. Airlines, origin destination into host metros, not system-wide ASM vanity. Media, ad load sold versus ad load filled. Local services, security contractors and stadium catering, often private, often invisible in equity narratives. These 5 pieces do not move together, and treating them as one trade is the myth this episode exists to break. Apparel is a global earnings story, where the cup is a seasonal footnote. Hotels and airlines are hyperlocal, tied to a handful of host metros for a few specific weeks. Media rights were priced and locked years before kickoff. Local services, security, catering, cleaning, rarely touch a public ticker at all. Collapsing 5 different exposure types into one World Cup stocks idea is exactly the pattern matching that costs retail traders money on narrative days. Country scale changes the storytelling. Mexico's tourism share of the economy is not Canada's, and neither is the United States. Say so before a chart misleads. That fact alone deflates the urge to play the cup with concentration. If you do not invest, the episode still teaches how headlines try to recruit your attention into someone else's liquidity. Curiosityverse will not tell you to buy sportswear in June. We will tell you how event narratives enter price, and how often they fail to explain the quarter you actually lived through. So when the World Cup makes headlines about markets, separate the story from the earnings. A jersey sellout is not a stock signal. A 5 billion person audience is not a guaranteed dollar. Curious how that same instinct, chasing a good story instead of good math, plays out at the sportsbook. Watch our betting versus investing breakdown next. Curiosityverse, numbers over narrative, not financial advice. Thanks for watching.